Okay, so anyway, I don't want to keep us for too long on Valentine's night. So footprint. So basically, I think the numbers here are a bit blurred out, but it's actually not the exact point of the numbers right here. What I do look at, so this is the kind of two different, on the office, this is the kind of two footprints you will see. This footprint here, a color-based footprint. So looking at the depth or the delta, because I know there's people asking about delta, so this is why I wanted to keep the delta questions for the footprint. The coloring determines the delta versus the aggressiveness of like the depth, the volume or the size done of delta prior to other prices. So when you have like this kind of color or discoloration, you have this volume and this aggressive delta that was done, here versus relative to other prices in a rotational footprint. And then the other one you might see, for example, I use a lot of these in the bonds, where I'm not looking at perhaps always the numbers per se. I'm looking at the shape of the footprint. Okay. And if you understand, the reason why I said to people, if you understand market profile, this should make a lot of sense to you, because all markets are fractal. And if you look at, for example, sometimes I'll bring this back. I'll just move this somewhere else. If you understand markets are fractal, patterns will keep playing out on different time frames, of course. And if you understand the profile, like for example, distribution. So if you understand double distribution days, this kind of trading should make footprint should kind of make a quick sense to you. You don't need to learn footprint completely new. You can transplant your knowledge from profiles to the footprint, but on a sort of more micro level. So what happened was, this is BTPs, I think back on again during the summer, and so I'm not interested perhaps even on the colors on this one, on the shape, on just the shape. And why is this the case? Usually you had, so down here, you can't really see it in the screenshot. I had this from my old Evernote thing, but I think it's a good example where the market spends a lot more time developing, our structure and volume churning it. And then there was like this news, and we broke out of a big level out of the 53s. When I looked at my notes, we traded. We had a decent interaction by leaving this bulge, and then we traded back higher. And you can see, again, just understanding the auction theory, that as we trade higher and higher prices, it's likely that we're going to, the volume that we trade will be lighter and lighter. And you can see how the market came back and had to sort of find its feet and finding a buyer. Now, if you understand how double distribution days work, if I bring up Paint and I bring a new one, you'll notice that for double distribution days, you'll get this. You'll probably have the market spending a lot of time, in here. And there's some kind of news, some kind of change in information. We get this very thin, very aggressive movement. And if you think about this in terms of volume, and then the market will usually find its feet, like higher traded volumes, and then we'll spend the rest of the day trading this second distribution. And what you'll find by observing these days is that these sort of volume nodes, which trade towards the highs, they often become a great place of support, right? And just knowing that, you can understand what I was trying to observe with this footprint. This is the kind of footprint I have on a lot of the bonds, where I would expect the market to somehow find a bid within this kind of distribution, okay, at the very least. So as the market was coming back, it was rotating, we bounced off 66s, okay, a bit higher. And that's where we're getting the sense that the market's probably going to build the low of this distribution at these kind of prices. So it's kind of like very much similar to, it's kind of like, the way we were splitting the understanding how we were splitting the bid and ask volume on the jigsaw ladder. When I saw this, it sort of made more complete sense to me of understanding how, how this sort of works in terms of the auction process. So, and then the market comes back, and you can see how when it was coming back, the volume was very thinning out. There was less participation as we came back down. And as we came back up again in this next column, there's increased volume. And because there's increased volume, there's more interest at higher prices. And then, we have that as if it is an auction, there's more people now wanting to participate. And the footprint, by doing it in this kind of shape, it's just kind of like these repeatable patterns that you can see. In this case, the double distribution, when you have this breakout, and then you're trying to look for some kind of pullback. And of course, while this profile is developing, you have let's say you missed it, right? Let's say there's some kind of breakout, and you're trading something else, and it pops, And then you'll see this kind of footprint. And as we're sort of building, the market's building, coming back down, rotates, finds a bid. And then that's when you can be thinking, hey, that's when I have great risk reward, because you can put in a limit order, you can find in the bid, put in a bid at 66s. You will not really expect it to easily get through 66s, keep a tighter stop, or look to come out, underneath. And then you have that asymmetry where you have nice tight risk, and then you can let it just, find that second leg. And so you've effectively found yourself a very beautiful, tight pullback area in effect. So it's kind of looking at it in that kind of perspective for these kind of shape-based profiles. And one thing I think will also now, I think you guys should understand, is using it also actually looking at the numbers. So if I now zoom in, so this is the 10-year, the US 10-year. So you guys might think, wow, I'm using a footprint for the 10-year. I mean, that's, you're going to get very fat footprints, of course, because, it's a bit of more of a slower market. Now, one of these kind of trades where, I still very much love and, like to trade when the market is very rotational, the market is very range bound, when nothing is really going on. The news is slow and, you want to be a bit more technical. One of the great things is when, for very thick markets like the US 10-year, which is often like 2,500, 3,000 bid and offered, the way it changes its size that has been trading, it trades thousands and thousands, it lifts the price, it trades barely nothing, comes back down. It's very distinctive. It's a lot more obvious, of my personal opinion, than it would be in crude oil or gold or something. And when you have this kind of, like let's say obvious, form a range, pullback, nothing crazy, this is very standard stuff. But when you combine it with this, the footprint, what you get is this finished auction. And I know finished auction is something, when people are introduced to the footprint, it's the first thing they look at. And I think it works very beautifully for, range-bound markets where this is the same level. So this is 28.5, you can see here. And this is the same one on the footprint. And you can see the market was trading decently up into the level. We're trading size and size. And then as we try and take out the level, we trade a meager 50 lot. And just think about it very intuitively. If there's the market, if this is, we're talking about a market that normally trades thousands and thousands at a price, and you're telling me that all it could do is lift a 50 lot into that level and nothing else happened and the market stalled, the market just sits there, and then more size, and they only lift 50, and then the seller starts selling back into this price here. You're telling me that we're going to get through that level just with that size? No. And then we come back down, we rotate. And as you can see, as we trade lower prices, the market comes back. Kind of like we just looked at our oil example. The market tried to rebid, and we rebid it with literally absolutely laughable size, like 129 lot. Like that's just nothing for the US 10-year, right? And then we came back down, and then we started selling it heavily again. And this is how we trickle down. I mean, I know it looks slow because it is a thicker, slower market, but that's the kind of nature. And this is these kind of setups where you can see more mechanical scalp style setups where you look at the way the market trades these lows or highs for perhaps reversals or continuation. In this case, we have a very range bound market. So contextually, we're thinking, okay, range bound market, we're going to look for range based strategies. And this is the kind of thing you will see. It's much more easier to see. I mean, of course, you can see this on the ladder. And now that I have looked at the ladder for like, I don't know how many hours of my life already, and of course, even more senior guys have looked at it for so long, you can see it on the ladder. But you're looking at many different trades, you're looking at many different markets. You want to make it easier for yourself for looking at it. So this is why the footprint is very useful. And of course, you can see these kind of shifts of patterns over time. So it adds conviction, to your trade. And again, same thing. We came back down, plateaued a bit. I believe this was 5 minute, 5 minute footprint. So we slowly come back down. But the thing I'm looking for on this kind of trade always, and this is the great way where you can keep adding size and you're tightening your stop. Every time we come back to challenge the offer, so the buyers come back in and try and lift the offer. Every time, look, 50, 129 lot, 58 lot, 16 lots, literally nothing's happening. And by the time we did all that, the market moved from here to here, and that's a very, very, very healthy, on a very slow market, on a very range-bound 10-year, dead market. That's a very sort of healthy amount. In fact, you can see it was in 19th of October that trade. So it's a sort of very healthy amount you can take out of. So that's showing you an extreme of a market, which is like a slower, thicker market of how it trades. And actually you can see that when it, came back down to the other end of the profile, same kind of thing, no size traded, and we started lifting. So that's, I would say, probably one out of the two footprints we look at. In terms of like shape and, direction. One more last example in the 10-year. Using what we just learned from our jigsaw ladder. Again, just to show you guys one more time. If we're looking here at the distribution of how much size sold into the bid, the red, and how much size lifted into the offer, or how much bought, then that's literally exactly what you're seeing on the footprint, but over a period of time. Again, same thing here. You're saying this number on the left is how much sold into the bid, and the number on the right is how much sold into the offer when it was like bid here and then offer there, and then obviously when we were trading here, the offer was here and then the bid was down there. And same kind of thing, the 10-year again, you can see how it's trying to break down the level. And this is the interesting thing, where you have, for one person, is how do you know there's a lot of positioning, especially over time? Well, this is it. You see how you look at the relative size of how much is trading, but then you look at the lows and say, well, someone has just exchanged the bidder and offered. As we've traded up and down, we have positioning of 11,000 lots either side, which means the buyers are now invested. They have their size in, there's a decent amount of size in this market. So they're probably like starting to sweat, like, okay, why is the market not going up? The sellers have sold 11,000 into the bid, and they're like, oh, how come we're not breaking? So this is now the kind of like, not a game of chicken, but like it's the wrong way, and a simplistic way of saying it. But it's kind of like both parties are locked and loaded, and they're like just waiting, like what's coming through. And this is the thing, the sellers were locked and loaded, and then it got down to here, and then said, oh well, no one else wants to sell at this price. I mean, there's only 859 lot. You're telling me we've gone from trading 10,000 lots at one price to someone only willing to sell 859 lot. That's not good. So when the market bids up and we bid up and we bid up, then the sellers are starting to sweat and think, well, hang on a second, no one was willing to take it through here. And then the buyers are now willing to eat through all of this liquidity and keep going up. And, at one time, then it's going to start unwinding their position. And that's this kind of thing you're looking out for, this kind of, everyone's locked and loaded, and, you're just seeing which way the market's going to give up. And the sellers obviously gave up, and we undid this positioning by trading up higher. So I think that's the power of the footprint when you're looking at it in terms of shape. Now, very quickly, one profile I within the footprint. This was the sort of next the next iteration, if you will. Even though I think the way I've evolved this. So for people ask me, what do I use? So I still prefer using this volume profile shape-wise for thicker markets, treasuries, sometimes burned on time-based. Okay, so time-based, like 5 minute, because a lot of the time the treasuries will sit there, and if you have it on rotation of 4 ticks, you can have one profile for the whole day, and it's going to be pointless. Okay, so, but for thinner markets, especially SPU now, it's actually improved my ability to trade SPU so much better. I used to trade like everything so much better, but SPU was always like my Achilles heel in approaching it, and sometimes. SPU is great to trade on risk events, obviously, but when we're talking about a bit more technically, one thing that changed the game for me trading SPU more technically is looking at a color-based footprint. So when you look at a color thing, you should sort of understand how people are coloring it. In this case, it's very simplistically coloring where we have the delta. So, the volume that has been done here, very simplistically, it highlights the volume that's been done relative to the rotation in the entire footprint, if that makes sense. And then it colors red or green based on the delta. So as you can see here, if you all know, delta is, if it's a positive delta, that means at that price there's been more buying than selling at market. So there's been more orders hitting the offer than selling into the bid at that price. There's been more buying. So this is why we highlight that, colored green, and then very simply red, negative delta. And slight changes in gradient, but basically but we only highlight the ones that do the most volume relative to the rotation. And I believe this is on a 10-tick reversal bar in the in Sierra chart. So basically, the way it does it is, our rotations work is it prints a new bar every 10 ticks, but then if it goes in the other direction, it's got to go, I think, twice that, like 10 more ticks for then to print a new bar. So that's why we have a longer bar here. And the reason why these are powerful, and before I didn't find the consistency I wanted in using the footprint until I realized I can combine with what I see on the ladder and the footprint as well. Because sometimes when the SPU also moves a bit quickly and you don't have the last traded quantity, sometimes if you're using TT, we trade back down. But then we trade, and then this is the thing. So if you see this a lot of the time, you trade it. Let's say you try and use this as a reversal. Let's say sometimes if you trade in a very reversal based environment, it will work more often than not. But I didn't find the consistency I wanted to trade. But then I realized when we do this, but the ladder, when I'm looking at the ladder, the SPU ladder just gets so thick and it gets very clumpy, and then the bid and offer just goes crazy. Like there's just so much being exchanged. Last traded quantity, like it's just like the SPU goes from being like a thinner market goes from being super like it's just trading on ice, like it's just moving up and down, and then all of a sudden it just gets so congested and just goes just so like agitated between a few prices, and then you see all of this. Sorry, there and you see all of this. That's when there's some kind of accumulation coming in and just some guys just stepped up and said, you know what, thanks for these better prices, I'm just going to take that. And what happens is all this selling, probably this aggressive selling chasing this move, and there's someone there just absorbing all of this, but absorbing all of this selling, and then the sellers try and come in and sell more, and they probably don't realize it yet that there's a buyer, and this is why I get this crazy exchange all the time between them. And then what happens then is this color will change throughout the period, so it's probably all red, and then as we pop back up into this price, and then we get this aggressive green delta, and then we pop up back higher, and then you have so those guys who are buying then say, okay, thanks guys, we bought it, and then they just step on the gas and just go bang, and then and instead of accumulating, just keep getting aggressive, because remember, there's two types of orders you can have. One is a limit, where you just stick your limit and then you're waiting for people to fill you, and another one is when you go to the market and you lift at market, and those guys just go bang, and they know that they just trapped so many guys in here. Again, I love positioning trades, unwinding positioning, and you can see a theme now in a lot of my trades. They just hoover up all the liquidity here and just say thanks, bye, see you later, and then rip the S&P higher. And you can see how that's if we look at the volume, much higher volumes, and the delta is just negative delta, and you have that sort of like that constant trapping where it's just this relentless. The sellers are locked and loaded and just relentlessly selling and they're not getting through, and then you have the unwind. So for the person who asked me, when you see negative delta throughout the day and you have the price keep going higher, this is what happens, where throughout the day you probably had very aggressive sellers constantly taking it, but there was just some very, very patient buyers sitting on the bid, just slowly accumulating all these orders, and then the sellers probably get out over time, and it's just this constant like gradual release of that. It's kind of like this, but a release throughout the whole day, if that makes sense, but not dramatic enough to just spike your delta to make it look the other way. You don't get too many of those days actually, but you do see it sometimes. Yeah, so Satoshi, we highlight imbalances on footprint. So depending which one we're looking at, if we're looking at the this one, I'm more interested about the shape. And then, yeah, exactly, John, be sitting on the limit. That's it. It depends. You see that more often, like sometimes in currencies. Currencies is difficult. I am talking about the ES, Leon, and Spulgan. It's the SPU or the S&P. SPU is just a nickname for it. So the ES, the S&P, I'm talking about here. Yeah, okay, yeah, so we have that, and then so Satoshi, yeah, imbalances on the footprint, yeah, so with imbalances, we're color coding it in terms of like a volume imbalance relative to its rotation, basically. Daniel, no, I have traded in Nasdaq before, like early days when I first started trading, but no, for me personally, I actually prefer thicker, slightly slower markets where you can just hit prices and so on, but the guys here who do trade Nasdaq more on news and things. So if there's like, I don't know, perfect one. If there are earning reports from the big, the FANG stocks or whatever now, the Nasdaq or Facebook, and they're moving it, they'll do it on Nasdaq. Or if there's some kind of, let's say, regulation threat coming in on Facebook and it moves to Nasdaq, they'll trade it on Nasdaq. But for me personally, no, I don't trade Nasdaq. I prefer just I don't trade equities that much. I trade more on the bonds or on that kind of space. Okay, so hopefully you guys now understand how which sort of transplanting what we learned here off the jigsaw ladder with these two columns and onto the footprint. So now if you look at the time, okay, I think we're now pushing the limits, but I can talk about this for a long time. Let me show you one more quick example. Okay, perfect. Boom. Okay, so beautiful, beautiful trade. And I think if you guys ever have this replay, I remember this trade very distinctively, and I'm so annoyed I missed it, because this is when I started to, you know, trade more SPU and be a bit more aggressive with it. Sorry guys. Okay, I'll just keep it like this. So I remember this day very distinctively. So this was on at the beginning of the year, 25th of Jan, 2021, obviously. And basically we had this very sort of like weird risk off that just came in. It was more of like a sentiment thing. Like there wasn't any, there was some kind of like variation of strains of vaccines, but it wasn't that definitive. It was kind of like the sentiment. And how do you know it was sentiment? You're not guessing. Well, the bonds just keep finding bid. The bonds keep getting bid. And then all the risk assets keep coming off. So you know that there's a bit of like fright and scare keep creeping into all the assets. Okay, so basically, yeah, you had this kind of like liquidation, and this kind of flow you had in the SPU back then was like, it was very sort of like relentless, like, you know, sell, and it was just like the book was just so heavy and just pushing it down. And there's a lot of people, you know, frustrated about, you know, pullbacks in SPU and how you get them, and it was difficult. But this is one pattern I've seen so much before in SPU and a few other markets where, so you see this pullback we had, we came down all the way to like 08, we pulled all the way back, and then we had this congestion area. And obviously this is like after how I pulled back, but the thing is, in real time, all you'll see is this, right? And you're thinking, Jesus, I've missed this entire move. You get frustrated and you're like, oh my God, and then you're gonna start selling the low, and then you've done your whole week, and you've reached your stop loss for the week or day or whatever, just trying to get too aggressive, getting caught up in this. Anyway, so you see this and you're just thinking, how is there going to be like a pullback? The ladder is just so crazy at the moment. Well, when it does pull back, what you look, and obviously the squeezes you get in SPU are like, they'll rip your face off. Okay, so you don't want to be, yeah, they'll rip your face off. You want to be a bit more careful. Anyway, what you do get is this. So you had this thing where we had on the second leg, so we made it a little high. So this is not you being perfect and saying, okay, I'm just going to sell the high here on this pullback, obviously, as it comes back. So we traded the highs at like, I don't know, 22s the handle, and we came back down. And as we started taking these down, you saw it was coming back down. And then as it did, you can see how you know, there's decent size trading into SPU. We made a pullback, and then all of a sudden again it's the same thing. We traded, we popped, and then we had this insane congestion where you see how it's green, and we had like positive delta, and there's so much volume, and there's so much more volume transacted here than in any other part. And again, not only are we looking at the footprint, but we're combining it with the ladder and just what's going on generally with your correlations. You know, the bonds are keep going, they're still risk off. So you have risk off, tick. We have liquidation probably continuing, tick. We may have a decent pullback, tick. And you're seeing this, and then you're seeing just the ladder shifting from just being super like flowy to just being stuck at these prices and just churning it for so long, and taking the time, and just this like, again, everyone's getting locked and loaded into like buyers and selling, getting too wound up about this price, and you're just seeing like, you know, what's going on, and then it sort of creeps back. It sort of creaks like a ship, like it just creaks lower and lower and lower, and you just feel like any moment now these buyers are just going to give up, and you know, you're hoping to get some of this, and then the buyer's just going to give up. So you have that interaction zone. But this is why it's so great, where you have this clump of congestion, and you know that this is perhaps probably the best place where you can start to feed in a clip or two clip, keep your stop tight, and you sort of like moved yourself slightly away from the sort of the noise of like the crazy, flow, and then and then you sort of liquidate. And probably the guys who got all caught up in here, probably, likely people who saw a bounce, there are people trying to fade all this because they're like, oh my God, amazing price, let's fade it, let's buy it. And they saw this little pullback and they said, okay, we're going up, they buy it, and then it just gets sold back down, and then boom, we have the second leg, which is even better.
If you find this video interesting, if you want to go deep into the Axia training method and how our trading team of 7-figure traders develop setups and strategies, and how they learn to build the most profitable trades, across all market environments, then join me in this workshop. Now in this workshop, you're going to learn 3 powerful steps we use to train all our traders on both our London and our Poland trading desks to help build incredible levels of consistency. How to predictably understand which setups work and which don't. You're going to learn our 2 main strategies for how we perfect our trade timing before we enter every single trade. You're going to learn the VEL concept, which is our one and only technique we use to leverage our largest trades. You'll also learn how to avoid trading setups that don't work, how to avoid those large losses, and our main method we use to identify them that saves our traders significant amounts of capital. Finally, you will learn how our traders use the power of network learning to find market patterns quicker than ever before, so you shortcut that learning curve. In the workshop, we want to program your awareness of elite performance, to program your ability to choose the right setups, and program your ability to be a consistent trader. So the trades that you execute become more simple and clearer. And I can tell you this, you'll never see the markets the same again. You'll never look at the markets with a narrow view of getting lost in all the noise and confusion. You'll take your first step towards a deep edge market awareness. I cannot wait for you to join me in this workshop. And I think you're in for a massive paradigm shift in your understanding of how to develop as a trader. So join me by clicking on the top right-hand corner of the screen and sign up for this powerful training workshop, or visit elitetraderworkshop.com.